Hello, everyone. Welcome to the October 2025 IndiView Market Update and Outlook. I am Jeremy Bryan, and this is powered by IndiWealth. Today, we're going to take a little bit more robust look at what's going on in the overall economy, what's going on with stocks and bonds, and what we would be doing from an outlook and positioning perspective. So we do this one on a quarterly basis. So this is our most robust look because we want to see what's going on and how we would position portfolios. So let's start there. Let's start with a little snapshot on the asset class performance, which has been very, very good. I don't think you can say it any other way. Is that look at the numbers here. The S&P 500 is up almost 15%, actually over 15% at this point right now. Recording this in early October. International stocks have done extraordinarily well at up well over 20%. As a matter of fact, what I did a little research and looked at ticker symbol ACWX, which is an ETF for all country world ex-US. So basically all investable assets outside of the US. And that performance is up 28.6% as of 10/3. I looked for a better year. So if we ended the year at that 28.6%, that's the best year since 2009. That is a very, very strong year in the markets for international stocks. It's just been really, really strong. A little later on, I'll get into, I don't think it's all just business and people saying now's the time to buy internationally. I think the dollar and the dollar decline of the year has something to do with that. And we'll talk about that when we talk about positioning. But turning to the worst performer on this list is fixed income at 6.1%. 6.1%, even if we were to end the year at that exact same spot, is a really good year for fixed income. That is not a problem at all. So a balanced investor who takes a little bit of an approach of all of these assets in a blended basis to kind of give them a balanced level of risk is up 13% year to date. That's very, very strong. That's a good year. Across the board. So even without the tailwind of usually October, November, December are our most favorable months from a seasonality perspective. Again, we don't invest based upon seasonality, but we do understand historical precedent, and historical precedent suggests that usually the last 3 months of the year are among our strongest. Not every year, but a lot of the time. But even if we were to stay completely flat for the rest of the year, 13.1% on a balance, 15% in the S&P, and your international stocks at 25% plus. Gold is up 40%. Silver, I think, is up over 60% at this point right now. And even your fixed income at 6.1%. That is a pretty strong market across the board. Turning to economic growth, I look at GDP for that. It's our best barometer of just how we're growing. And if you remember back in July, we were talking about Q1 data that showed there was a decline. Q1 was declining GDP. Q2 had a pretty strong rebound. Q2 GDP was 3.8%. So I would call the first half of the year more of your average to slightly below average. If you take it in aggregate, we had the one decline, and then we had a pretty strong rebound. It's about average to slightly below. Q3 now, we don't have the final number for Q3 as of yet. We just closed it not that long ago. But we do have an estimate from the Atlanta Federal Reserve. And the Atlanta Federal Reserve, the GDP now estimate is 3.8%. That's as of 10/1. Another 3.8% off of the 3.8% in Q2. Now, I will tell you the consensus estimate among economists, the forecast, what they call a blue chip consensus, is a little lower than that. So it could come in at a number. But I think we're really looking at growth again in Q3 and probably slightly above average growth in Q3. So we now have gone from what I would call, the first half of the year being slightly below average to now average to maybe even slightly above average in GDP growth. So again, another good backdrop for the economy is still in growing phase, which tends to be a good thing for the market. But what I will tell you is, again, GDP is a historical looking number. It really doesn't tell us a lot, and markets want to know and investors want to know what's the forward look like. So while GDP is our good measure of how we've been growing, it really doesn't tell us a lot about what the market is anticipating for future growth. But let's turn to jobs. Jobs, the unemployment rate is what we have here. And the number of unemployed is at 4.3%. That is historically still well below long-term average. So this is a job market that is still relatively healthy from an unemployed perspective, is that we don't have a lot of people searching for work that are out of a job. What I would say here is one thing is I think the number we're in a decelerating mode is that the unemployment number has slightly rising. It's not rising aggressively, but it's higher than we were in July. And also, we're seeing jobs growth from, the Bureau of Labor and Statistics data has been steadily decelerating. So I think we've gone from a healthy job where a lot of people were looking at, hey, I can get a next job and get paid. And even then I can get the next job from there and get paid even more, to now the sentiment being around job holding, right? I don't think we're in big job loss. We're in some of that, but I think we're more in job holding territory right now and saying, I'm not hearing from my friends as much that they have a job going on over here that I can make more of and then scale that up. It's more, I'm just going to hold with what I have right now and be fine that I actually have a job rather than thinking I can scale up and up and up and up. So I think that's what it's changed to. And that can have some impact on the sentiment of the consumer. Now, again, if they have a job and they're comfortable with that job, they may continue to spend money. In fact, I think at 4.3%, I think we will. But if that number continually steadily rises, we start to see from job growth to job contraction, and we start to see incremental layoffs happening, then that can have a pretty big sentiment shift of what's happening in the overall economy and how our economy grows. If you've heard me say it once, you've heard me say it 100 times. I think jobs are the most important, or at least one of the most important and critical factors, especially job sentiment around consumer spending. And consumer spending is how our economy grows. So I think it's critical to continue to pay attention to this. The problem right now is we're in a government shutdown. So you can see the last report here is from August 2025. I don't have September's data because they didn't report it. I wish we had that data. It would be better if we did than if we didn't. We can use some other data as proxies. Challenger and ADP are some private companies that do jobs-related trending. They're not perfectly correlated, but they can provide some analysis in the time that the BLS is out. We'll see how long that entails, but in my opinion, the numbers have suggested, and again, we don't have the numbers from the BLS, but we do have some Challenger and ADP, is that slowing environment has continued to slow. We haven't reaccelerated it. And I think that's probably where we are to year end, unless we see something of a catalyst change. And I don't really see that in the cards at this point right now. So I think I would expect a continuing deceleration market. I'm not in the camp of contraction yet. We're certainly not in an area where unemployment is, an aggressive concern. We're still well below long-term averages. But if we continue to creep that number up, that really does have some negative influence on consumer sentiment, which has some negative influence on the overall growth of the economy, which can hit the stock market. So you have to understand that this is all correlated. Right now, we're not in red flag territory, but I would call it a bit of a yellow. Turning to the inflation side, we have CPI here. This is core and headline CPI. Just for quick, headline shows food and energy. It includes food and energy. Core CPI takes that out because food and energy tends to be pretty volatile. That's all that really is the big difference. I just look at both and I say both are still elevated at this point right now. These are above the targets that the Federal Reserve has set as normalized inflation. Normalized inflation is 2 to 2.5%. Both are above this. Core CPI at 3.1, the last number, CPI at 2.9. The other issue about these is we're at least flatlining. We're not coming down like we were. We're kind of either staying steady, and actually the last few numbers have been slightly increasing. We don't know the impacts of tariffs on this still at this point yet. You'd figure we would. We have not seen evidence that it's been has been really aggressively influencing an acceleration of inflation. The numbers have not aggressively risen, but we do have to continue to pay attention to that, because if this number is rising, it's going to be difficult for the Federal Reserve to continue on this easing stance that they're doing, which I'll talk about here in a minute. But really right now, if you think about it, that the dual mandate of the Fed is full employment and controlled inflation. clearly right now, because they are starting to do some easing, they think the employment situation supersedes the elevated inflation that we currently are experiencing. So we'll continue to watch this. I don't see an avenue, I do see an avenue where we continue to minorly uptick these numbers and that inflation does rear its ugly head a little bit here. I don't really see the scenario where we start to see what we experienced in the early 2020s of that rampant 5, 6, 7, 8, 9% inflation. I just don't see a scenario for that right now. But inflation is not controlled as of yet. It is better than it was before, but we have to pay attention to it if we're going to start, to make sure we're not starting on the wrong trend again. So again, talking about the Fed funds rate, this is what the Federal Reserve really controls and how they try to control those two elements that they discussed before, along with other things. But you can see that we have experienced a cut in September. And as of October 6th, there is a 95% probability of another cut here in October. And the market and investors are anticipating, with a pretty high probability, of 83% chance of 2 cuts by year end. So one in October and one in probably December. So it'd be 3 cuts total for the year, the one we've experienced and the 2 that are forthcoming. That's what the market believes. That's what the probability is. Pretty high. I mean, 95 and 83%, that's a pretty high probability that they think this is going to happen that way. In my opinion, the Fed does not have an easy job right now because they have conflicting signals. Clearly, I think the employment situation is slowing. And usually they would be there to support that because you don't want slowing going into contraction, going into massive layoffs, which creates economic problems. So the support component of that by cutting rates makes sense to me. The other side of that argument, though, is that we have not controlled inflation yet, and we're not bringing it down further at this point right now. In fact, it's starting to creep up a little bit. In that scenario, you would think the Fed would be holding rates steady because you don't want to cut rates in a scenario where you already have rising inflation because it can exacerbate it. It can increase that chance that we go into those 4s and bigger numbers that no one wants to see again. So this is not an easy job right now. This is not perfect. The other side of this, what I find kind of interesting is how artificial intelligence and the massive amount of investment being put into artificial intelligence changes the dynamic of what we're doing from Fed economic policy. And the reason I say that is under a couple of things, is that artificial intelligence, every company on earth right now is trying to figure out how artificial intelligence plays within their role. Whether that is supplementing the people they have and increasing their productivity, whether it's replacing the people they have to increase their own profit and profitability, because AI can do a lot of the functions that some people are doing now. It's an interesting dilemma. And the other component of that is the capital investment right now. Capital investment is extraordinarily heavy in AI influenced stuff, artificial intelligence. Alphabet, Meta, Amazon, Microsoft are spending billions upon billions of dollars. And you're seeing agreements that are really just escalating from the amount of capital expenditure that goes into there. The part about that is these companies are a little less sensitive to interest rate changes. They're more susceptible to perception changes or economic changes or just value proposition changes than they are to interest rates. If you think about history, interest rates, you had to go buy a building, right? Because you were expanding internationally. So you got to buy a new factory, which is going to send the widgets over there. Totally understandable. And then interest rates play a big role in that because you're going to finance that building and the costs are, if they're exorbitant, it's tougher to make the argument that it's worthwhile. For these AI related assumptions, I don't think they're thinking about interest rates as a factor hardly at all, right? Because they generate a lot of cash already, and they think the economic opportunity of artificial intelligence requires them to spend aggressively to do so. So I'm not sure if this changes the dynamic as much as it used to in the past. I could be wrong about that. It's something we'll have to kind of examine because we've never gone through artificial intelligence before. So we'll see where that ends up. I just think it's a different wrinkle. The other wrinkle I want to hit on here quickly is you can see the market has that anticipation number, and the economists and the Federal Reserve have that anticipation number of really ratcheting down on a lower basis, controlled over time. Look at history. History tells us we don't do that. History tells us we react to things, and we act to things aggressively, both in a supporting mechanism and a restricting mechanism, right? Is that we raise interest rates fast, we lower interest rates fast. It's rare where we get the opportunity and the pleasure of this slow bleed downward. Usually there's a catalyst or something happens in the markets or in the global economy and just the world in general, geopolitical, whatever that may be, that changes this course from this smooth ride to a bumpier ride, one way or the other. If inflation does rear its ugly head and we start getting really rampant, tariffs are influencing that number could reverse itself right back upward. On the flip side of that is if this if this job growth slowing turns into contraction, turns into consumer sentiment being pretty negative, which sentiment is already pretty negative, but actions have not been. So I always say, follow what they do and not what they say. They're saying they're negative, but they're still spending money. But if that still spending money kind of goes down, then this could go down significantly faster as well. So you have to understand that this projection going forward is a projection that is probably not based in a lot of reality. Let's turn to the markets themselves and what we're kind of getting from a snapshot of the investments themselves at this point right now. So this is your sources of bond yield. You have treasuries, US aggregate, which is a blend, mortgage backs, investment grade, and high yield. The blue bar shows their current yield to worst, which is basically what you're getting when you invest in a bond at this point on an average basis, versus what their long-term average is in that diamond and that yellowish color, whatever that may be. You see it's above the 2009 to current average. What I would say is that average, and I've said this before, is that average is artificially low in my opinion, because this is the first time in history where we've messed around with zero interest rate policy. And so zero interest rates are going to have a suppressing average number because we were at zero for quite some time. I don't believe that that's the equilibrium. And I would suggest right now, those bars that we have that we're currently experiencing are average to maybe even slightly below average if you take a longer, like a 50-year lens out of it. So I don't believe that that's the proper number to say that, oh yeah, we're above average, these are opportunistic. I honestly feel a little bit the other way, is that we're still getting income, but the bigger component to me is you're not really getting paid to take a lot of incremental risk. So historically, you get paid to take two different types of risk. Maturity risk, a bond that matures in 2 years versus one that matures in 20 years. You should get paid to take the risk that thing goes into default in 20 years. Secondarily, you usually get paid for credit risk, right? Is the potential for default. An investment grade bond is usually a better risk than a high yield bond, but still you should be compensated for taking that on that higher risk that the company could go bankrupt. You're still getting paid for it right now, but the amount you're getting paid is significantly lower compared to long-term history. So it suggests there's just not a lot of bargains out there in the fixed income market at this point right now. And the amount you're getting paid to take that incremental risk, I'm not sure if it's really worth it too much right now. I would be leaning towards, and I'll talk about this in positioning, but leaning towards relative safety. We've had a pretty good year in the bond market. I would be holding some dry powder. And when those opportunities, because people are going to get scared again at some point, when they do, these spreads tend to widen. And then really what happens is current bonds become less valuable. And that becomes your opportunity to kind of take advantage of that and saying, okay, now I'm getting paid to take this risk. I think I'm getting paid quite well to take this risk. I'm going to take the shot here. I don't think we're in that environment right now. Turning to the stock market, if you've heard me talk before, you know that I say that the best correlation over longer periods of time to the stock market growth is earnings growth. And earnings growth right now is a great backdrop. We're anticipated for 2025, the S&P 500 is anticipated to grow 10%. 2026, if you believe it, is expected to accelerate from there at 13.5%. That's a really good backdrop. The other thing that's been positives from July till now is that those estimates have actually increased. Now, in the first part of the year, they were coming down. They hit the floor probably in that June, July timeframe, and subsequently have been coming up a little bit. Estimates have been rising because companies are saying, hey, we're still growing, we're doing well, we're increasing our earnings estimates, and so the aggregate goes up a little bit. Those are both really good backdrops for the stock market. Where I'm going to put a little bit of pause on this is on the next slide where I talk about valuation. But secondarily, I just think 2026 is a little optimistic. I think accelerating from this point in an area where I would call the jobs market, again, slower growth. Again, that relay factor of slower growth means less sentiment, means less spending. I have a hard time believing we're going to accelerate the earnings profile during that kind of period. Could this happen? Absolutely. A reacceleration of the economy could lead to higher and faster growth. Greater productivity from, hey, I have to hire less people, but AI is allowing me to do equal to more work with less people. I'm going to be more profitable. My earnings are growing, so that could accelerate that as well. So it's not out of the realm of possibility. I think it's just overly optimistic at this point right now. Turning to valuation, there's no other way to say this. The S&P 500 is expensive relative to its history. If you just look at this chart, goes back into the 80s. You're seeing right now we are at levels that we don't see outside of COVID in 2020, when that was because earnings just collapsed. And so the market didn't collapse as much as earnings did. And so it got expensive. It was a weird little differential. The other time, tech bubble. Everybody knows what happened there. What I would say is now the composition of the companies right now is very different. There's no question that, we're a concentrated market in companies like Meta, companies like Amazon, Microsoft, Apple. These kind of companies provide, NVIDIA, are massive amounts of the S&P 500. So we're very concentrated in those, and those tend to be, right now at least especially, they throw off a ton of cash. They have good earnings growth. They have probably better than average earnings growth, and they're big. So from that perspective, it's just a different economy than it was from the tech bubble, where this is not pets.com, right? Is that the companies that are driving here are massively profitable, massive cash earners, cash generators, good businesses. But at the end of the day, unless you feel, and then we're hearing more of this in the overall markets out there, and hearing a lot of strategists saying it's different this time, is that these companies are just systematically different than the prior ones and deserve a higher valuation. I actually don't disagree with that, but I worry about how far we're stretching that analogy. Because yes, the numbers from maybe the 1980s, the composition of the market then was just very different. So should we take the same valuation argument from the 1980s as to now? Probably not. We probably should give them a little bit higher. And so if you think higher 16 average is maybe 17, even 18 at this point right now, it's entirely possible. I can see that. We're still at 23 times. So we're still above average even on this elevated basis. And so what I'm telling you is I think this market, again, there's not a lot of bargains to be had. There's a few, but it's becoming more and more rare. But if you're looking at this and saying, okay, so the next 6 months, this is going to be terrible because we're expensive right now. That's absolutely the wrong way to look at it. Expensive can always get more expensive. Cheap can always get cheaper. And especially in a 6 to 12 month time frame, valuation is a terrible predictor of longer term or of short-term performance. Where I would use this is, again, establishing what your long-term trajectory kind of looks like. And in that regard, I would think you would probably want to have, if you think the market is 8 to 10% on a long-term average return perspective, you probably want to expect yourself to come in below that because you're paying more for it right now. So even if the companies have changed, even if the market is different this time, you still want to be prepared for the fact that you are paying more than you paid in the past, and that I would expect below average returns over the next 3 to 5 years. Now, again, this can correct itself very, very quickly, right? Is that if you look at this chart, even in general, you can go from very high valuations to average to below average valuations very fast, to where I'm saying below average returns. But if we have a significant correction in the markets, well, it can go to average or even above average returns pretty quickly. So you got to understand this changes from time to time, but where we are right now, sitting at all-time highs, which honestly, I don't worry about all-time highs. That's not a concern. Where I'm a little bit more concerned is what we're paying for the earning streams right now, especially since I think 2026 is a little too optimistic. We're at very high valuations. Both of those numbers could come down, which would suppress the performance of the stock market. Turning to pullbacks, I always joke when I say this. I'm going to say it quickly: is that the bars are the performance by the end of the year, the dots are the performance, the worst performance during that year. Pullbacks, I'm often asked all the time: do you expect a pullback? Yeah, I sure do. I can't tell you when, but it happens all the time. We already had a 19% pullback in April this year, and a 14% plus market. So the markets returned 14%. We had a 19% decline during this year. So it happens all the time. You have to be prepared for the fact that how you generate above average returns in the stock market provides, compared to bonds, compared to cash. How you get that is you have to live through the ebbs and flows that the market has. And you can see by this chart, 78% of the time, this is just 1980 to 2024, 78% of the time, those bars are positive, and sometimes are very substantially positive. You can see a lot of good numbers in there. During almost all those years, we've experienced at least a 5% correction. In many of those years, we've experienced a 10 and plus percent correction. This year alone, we had a 19% correction. So these corrections happen all the time. And again, it's going to happen again. And if you're waiting for all clear and uncertainty being cleared, the market is going to move way before you on that. The classic example is right now and currently. We are still dealing with tariff uncertainty. We don't know. I said it before in the prior chart about tariffs. We don't know how much that's going to influence CPI. We don't know what those tariff levels are going to be. They're battling it out in the Supreme Court. There's adjustments. They want to change. There are going to adjustments to the adjustments. All that fun stuff. We do not have an all clear on the tariffs. If you had said that in April, it's like, I'm going to wait for the all clear. This market's going straight down and nobody knows what's going to happen. Well, you'd have given up a lot of performance waiting for that certainty. That certainty almost never arises because once you have certainty about one thing, guess what? We're just going to replace it with another concern that's down the board. So you have to understand and deal with uncertainty. But if you really stay the course, that's how time is on your side and how you make money in the stock market. And again, this just kind of relays that same information, is that your time is probably the most critical aspect of what you're going to do with your money. I say that as your objectives are absolutely important. You want to know what you want to do with your money. Your risk assessment, your risk tolerance level should not be inconsistent with time. It should relay based upon the time you have to get what you want. So if you're saying I need the money in a year, I don't care if you're the most aggressive investor on the planet. You should not take that level of risk, because look at the 1 year performance in stocks. On a 1 year period, you could have your average return is 13%. If people are saying, hey, I'm going to get average, hey, I'll take 13% all day. It's great. The problem is that you have a range of 60% plus, which would be phenomenal if you got that, but minus 41%. And if you need that money in a year and you're down 40%, are you going to be thrilled? I don't think that's a risk worth taking. I think in the short term, you take less risk. As you move out in time frames, 5, 10, 20 years, you see those ranges tighten. Those ranges become smaller and you can get a better assessment of what it looks like. So again, your time matters, because in the short term, you should increase your certainty because you're going to need that money in the next, let's say, 12 to 18 months. All right. But if you're talking about 20-year money, I don't care if you're a conservative investor or a balanced investor, we should absolutely assess that to understand how your mentality will be. But the time frame suggests you should deal with some level of uncertainty to increase your overall return profile, because you have time on your side. And as that time shortens, you increase that certainty and reduce that level of risk. So let's close with the path forward here. So you see I have July 25 to October 25. July 25 was the first time we did this for IndiWealth. Going forward, when we do it in 2026, we'll do a year-to-date scorecard. But will political noise and rhetoric finally give way to actual economic analysis? Not likely. I got that right. We are going to have to deal with Washington uncertainty for I mean, for a long time. We're always uncertain with regard to that. It seems it's heightened now, and I think that's absolutely accurate. If you're feeling that way, I think you're actually right, because we're doing things we have not done before. So from that perspective, I don't think that's going to change, but I absolutely got that right. The Fed will cut at least once this year. We're on course for 3. I think jobs would say that that's accurate. I think inflation would say that's not. So we'll see where I think we're probably, there's 95% probability. So I don't think I'm going to go against that for another cut here in October. I think the December one might be a little bit more uncertain compared to what the expectations are. Again, we'll see what happens. But I think if we start to see inflation creeping its way back upward rather than flat to downward, I think that's an opportunity for them to say, for the Federal Reserve to say, we probably got to hold off here to make sure that we're not exacerbating a problem. Trade deals likely wane as stock market positivity. I think that was right, but it's not like the market has not been positive, right? As it didn't need that as a catalyst. It had plenty of others that it used to continue to go upward. Lastly, we've recovered back to all-time highs. That alone is not a reason to sell. That is absolutely accurate. I think that's very, very true, and I think it still holds true. You're going to hear me be a little bit more cautious on this time around, but still, again, am I advocating for selling everything? No, you're never going to hear that from me. But there are avenues and approaches and conservatism that I think should be incorporated into your portfolio performance based upon where we are right now. So if you look at the outlook, take myself off the screen here for a minute. Will we ever get scared again? Yeah, we're going to get scared again at some point. It doesn't feel like that right now. There doesn't feel to be a lot of fear in the markets right now. It will surface again at some point. I can't tell you when, but we will get scared again, and we'll start to see these things start to roll over. And that's when corrections, and a lot of times overcorrections, can occur. Housing, I think affordability, even if we start to see some rate declines like we saw in that chart, I'm not sure we're going to see the level of activity that we anticipate usually from rate cuts, where housing becomes more affordable. Reason for that is that housing prices to income is still at near all-time highs. It's higher than it was in 2005, 2006. Now, this isn't economic crisis, housing crisis perspective because of 2 things. One, a lot of us have very, very, very cheap mortgages, cheap mortgage rates. But that is acting as a suppression for activity, right? Is that they don't want to give up that mortgage rate. It's great. I'm paying 2.5%, 3%. Those kinds of things they don't want to give up. So that's going to suppress activity. The other side that's going to suppress activity is housing prices are still high. Now we're starting to see that come at least flatline and maybe come down a little bit, but it's really difficult when that income to, the housing price to income ratio is so high. It's just really hard that even if affordability rises because interest rates come down, it's still difficult to say there's going to be a massive amount of activity in housing given that rates, because of the job situation and because those ratios are still pretty skewed. Most asset classes are not bargains at current levels. They were really not. Fixed income is, again, we're not getting paid to take a lot of risk. The side of stocks is we're at near all-time high valuations. From the gold is up 40% plus, silver is up 60% plus, Bitcoin is up over 30% year to date. We've had really substantial performance over the past, few months, and especially recently, to where to expect that to continue and to plan based upon that is difficult for me to see. We're just not getting the bargains we are right now. That would tell me that unless we start to see a massive reacceleration of the economy, or something happens that really provides a trajectory that continues to go forward, I would have a hard time suggesting that we're going to stay at that same pace that we've seen thus far this year. So what does that mean for positioning then? It means now's not the time to be adding risk excessively. Bring back to equilibrium risk. If you were a 50-50, 50% bonds, 50% stocks, you're probably not 50-50 right now because the stock market has had a really good year. Fixed income has had a decent year, but it hasn't kept up with the stock market. So bring that back. Bring that back to equilibrium risk. And I would even suggest it might be prudent to bring it back slightly below your equilibrium right now, just to give yourself some dry powder for better opportunities down the road. Again, am I saying sell everything? Absolutely not. But rebalancing. So if you're 50-50, if you go to 45-55, it's not the worst case scenario in the world. You're still going to participate if this rally continues, which it absolutely could, but you're also protecting yourself. You've taken some profits and you have some dry powder on the sidelines to take advantage of better prices down the road. Fixed income spreads are minimal. I would stay short maturities and I would stay relatively safe. You're just not being paid to take a ton of risk in the fixed income market. So don't do it. I think it's just better off to be relatively safe at this point right now and use your opportunities when the prices are better. On the stock side, some of the recurring revenue defensive type of models that you see in consumer staples and I'm not going to say utilities. Utilities have actually worked fairly well lately, but some of these recurring revenue models, people are starting to sell those to buy this, the real growth, really concentrate themselves into AI type of structures, which has been beneficial. If you've been a part of that over the better part of 6 to 9 months, you've really benefited from it compared to some of these other companies. I would say be careful with continuing on that process. And a matter of fact, you may want to rebalance yourself back into some of these historical, tried and true type of recurring revenue models to give yourself a little bit better chance for some upside. And also some protection if those big guys do decide to, or whatever happens, that maybe those have experience some decline. On the international side, I do worry about how much their performance has been linked to the dollar. The dollar has been basically on a downward trajectory almost all year, which has propelled the international stocks higher. If that were to flip, if the dollar were to start getting stronger for whatever reason, the dollar can be a little fickle from time to time. If that were to turn the other way, you turn that tailwind into a headwind for international stocks. So I think they absolutely hold. I think they're still cheaper than the US markets, even though they've had substantially higher performance this year. They're still much cheaper than the overall markets. I still think there's diversification elements in owning both. I just wouldn't be piling in at this point right now because I do think there's a potential for a correction of that territory a little bit. If I didn't own them, I probably would add for the diversification element. If I own them right now, I'm probably rebalancing back to that prior equilibrium that I had before. So thank you very much for joining us today. I hope this was informative. I hope it was helpful. Tune in next month where we'll have more of just kind of an update to the performance, a little less robust. But then at the end of the year or the early part of next year, we'll do this again. Until then, thank you very much and take care.